Hello and welcome to another edition of the Goldman Guide. If you haven't yet subscribed, make sure you click the red subscribe button so you can be alerted to our uploads every week. Retail and institutional investors have been lauding this content, and we hope we don't disappoint them or you with the guide this week. We also hope you've had a very good holiday weekend. It's pretty cool when three religions' key holidays occur at the same time, isn't it? Anyways, I was doing a deep dive into the market. I realized it's been a rarity since we've had any real consistency in trading performance on consecutive days. Part of it's a lack of conviction, fear of recession, the economy, or crises like the recent banking situation. And on the heels of this notion, perhaps it's time for investors to also become more like traders, if you haven't already to some degree. Today we're going to talk a lot about cause and effect, how to play it, what to look for, and real expectations and sentiment about stocks and ETFs, as well as valuations and rotations. So let's get started. Now, last week wasn't so great for stocks unless you were long in the oil and gas sector, and small cap stocks really took it on the chin. They were down by almost 3% in just 4 days of trading. And see these three primary indices here? RSI wise, and using other technical features and characteristics, they're signaling buy, while the Russell 2000 is saying sell. This is our first example of cause and effect. The technicals for these three say buy. So what happens? They get bought and then overbought, especially on a valuation basis. Look at the NASDAQ 100 given its forward PE, right? Cause and effect. So what happens? A sell-off, or at the least a rotation into other equities, maybe international plays, other asset classes, or just simply into small caps, which might be in an oversold position. After all, when the big guys are overbought. Cause and effect. Buy signals cause buy. Overbought causes the effective rotation, oftentimes into oversold equities or similar asset classes. Now, it's not always this simple, but it can be. Our usual performance table has one very important characteristic this week, and that is the 52-week low. Since right now we've entered the period from last year when the sell-off in the market really commenced, these figures have materially changed from recent weeks. So this affects data points such as the DMA and others. So as you're looking at valuations and performance, please be aware of that. Now, stocks have been basically moving in line with events for the past several weeks, driven by economic and commodity or sector factors. And since settling in the current area, stocks have been largely trading in a narrow range with no change in sight near term. And small caps are going to be beneficiaries of rotations, as I mentioned a moment earlier, but I can't say when. It's difficult to discern or project when or what the catalyst might be, aside from valuations moving from the big caps to the NASDAQ 100. This week, the AAII and fund flows data are actually really telling. It tells where people stand and what's going on behind the scenes. So, for example, bulls went from 23% to 33%, bears from 46 down to 36. There was just an absolute shift here. That's not a good thing when you have such a big move in these areas, especially when they're equivalent like this. There was also a new survey question. This week's special question asked AAII members how the headlines about banks have affected their 6-month outlook for stocks. Now, the responses and the figures associated with these responses were telling. Now, we infer, as we kind of drill down a little deeper, that nearly 7 out of 10 respondents are showing that they're nervous and they don't understand the situation, while about 1 in 4 probably don't understand it at all, but don't see it as an impact directly in the market. It's just for the banks and the bank stocks themselves. Now, this aspect could be either proven to be an accurate perspective or also prove to be naive and costly. Only time will tell about that. And as it relates to fund flows on the ETF side, we've monitored these figures all year, inflows and outflows, as you know. But what has been happening on a year-to-date basis, which accelerated a bit last week, is a little bit unsettling. So the biggest outflows have tended to be all year long the S&P 500 index-related ETFs, followed by the Russell 1000 Value and Russell 1000 Growth. And not far behind is the Russell 2000 ETF. Now, unfortunately, these big caps and the bellwethers indicate by having these redemptions, it indicates that there's less than sanguine outlook by institutional investors and perhaps also by retail investors as well. Total redemptions or outflows are almost $26 billion, and these big cap names, as well as the Russell 2000 ETF, they represent five of the top eight redemptions among ETFs year to date. And Spider, that happens to be 40% of it, which is absolutely just wild. Now, recently we've had a new section here called Investing Considerations, and the idea here is that as you construct or make changes to your existing portfolio, you're managing it, you're deciding what to do, these are things that, as a portfolio manager, we would discuss in our meetings, and we would have ideas and changes in various assessments. And so, this is really what you should be focused on this week, in our opinion. So, aside from the goal of beating inflation, for example, are stocks attractive? And I would say no, not really, given the way the bond market is, inflation, the odd jobs data we've had, recession fears, high personal debt, and these valuations, especially when matched up against the projected growth rates for revenue and operating earnings. Might not be a bad idea to consider buying some stocks or getting into industries that are out of favor. Might be early, but it could be wise. Now, Q1 results, which will begin to be published in a few weeks, might not be too strong, and if they're accompanied by downward guidance by management or revisions by the street, might that be a trigger that big stocks are overbought? I think absolutely 100%. But the money has to go somewhere, and we don't see it going to real estate. Might go into other asset classes, could go into short-term debt, finally rotates back into other types of stocks that are out of favor, or industries out of favor, might even move back into crypto to a degree. Now, you may be familiar with the term GARP, growth at a reasonable price. We used to be GARP investors when we managed money. It's a term coined by a local Baltimorean, Eddie Brown, who's a great guy and incredible investor. So the question is it time to embrace this approach if we're near a period where we might be overbought in big caps, and yet the signals are sell in the small caps? I think that absolutely is the case. It can help you, quite frankly, engage in a form of risk management and maybe also assist you in uncovering a sector or a stock that has real upside without fear of a big sell off. And with this in mind, now's the time to have some money aside for trading in a tactical matter. This cause and effect we discussed earlier. You can put money to work in a sector or a stock that is GARP, which benefits from a specific event, like last Monday, for example. Oil jumped because OPEC announced that they're cutting production. So those stocks ran, especially the smaller ones. Crypto, a little while before that, had a nice run when the bank failures occurred. So be prepared for more events like this and have a plan on how to take advantage on a short-term basis. You can do it using ETFs or ETNs ahead of equity or sector moves in one direction or another. These are just some examples. Now, question about the banks. Can we ignore these issues? We certainly see lots of talk in the press and in social media by the major bank executives that there's a major issue here. I may be in the minority. I don't believe that it's a short-term event, but I also don't think it's an underlying issue that's going to crush stocks either. I think it's a little bit self-serving by the bank execs. I could be proven wrong, but that's just my opinion. And when more banks get into trouble, I do think we're going to have again a rotation into crypto. I've noted before that I'm long Bitcoin, Ethereum, and Shiba Inu. And if we have another run, I think that Bitcoin, Ethereum could be short-term plays. And foreign investors seem to be embracing these again more than Americans, quite frankly. So that's a positive going forward. And finally, if there's one sector that I think has legs and could go really far this year, it's AI, artificial intelligence. I know a bunch of stocks have already run. I know that they continue to run and have its detractors as well. But quite frankly, if you can find a firm that has a real technology and a real model, not just the initials AI in a company description, it will probably do well. So that'll do it for this week. Thanks for listening. We hope you enjoyed it. If you have any ideas about anything we talked today, please drop me an email. I welcome your thoughts. And remember, nothing we discussed today is a recommendation to buy or sell. They're all discussed for informational purposes only. Thanks again, and have a great week.